What is up guys, it's the Dragon, back today with another video. So in today's video, I'm going to be showing you the number one reason why most Forex traders lose money and what you are doing wrong, which is causing you to lose a whole bunch more trades than you need to be. For some traders of the requisite skill, this actually might be enough to take you from winning most of your trades to nearly ever not losing a trade. Now, I want you guys to bear in mind, this video applies to nearly everyone. This isn't just for breakout traders or swing traders. This applies to retracement traders, people who look primarily at Fibonacci level, and whatever strategy people are using. This tends to apply to all of them. Now, you might be wondering, what is this one thing which is needlessly causing a bunch of people to lose trades who really don't have to be? I'm going to show you right here. We're going to hop on the charts. I'm going to give you basically an example of a situation where this might happen for some swing traders or retracement traders before proceeding to how this happens to breakout traders and how you can avoid both. So before we get into specifics here, let's take a little look at the price history. So basically we're looking at GBP USD a little bit in the past right now. The price has had a crazy rally upwards. It's gone all this way up and then it's finally had quite a large drop right here. So what will often happen in basically all markets after the price has had a huge rally and then has had a drop, it's not just going to drop off the edge of the map, it's probably going to have some sort of complacency shoulder, some sort of minor retracement. But talking about this in GBP USD, let's see how this pair played out and what actually happened. So the pair seems to have made quite a big leg up. It's moved all the way up here. Now let's take a look at some of the potential supports and resistances for this pair right here. Now we've already drawn a resistance up here. Now let's draw another resistance right here since we're seeing quite a lot of rejection over here. Let's look to see if there's any diagonal trend lines. We might see might draw something like this. And then finally let's just draft up a quick Fibonacci level. Let's take a look at this. Now it seems to be coming close to quite a few confluences. So it's come close to this resistance. It's come close also at the same time as the Fibonacci level. So let's see how the price action plays out. So what's happened is the price has moved up. It's then posted a small bullish candle here and then a bearish candle of the same size. If I look closely, it looks to be slightly longer. So right there, it's posted an engulfing candle, a bearish engulfing candle. Now, a lot of you guys who are doing basic support and resistance strategies might look at this and you might think there's a sell in there, right? So we've had an engulfing candle. It's hit this resistance. It's hit this Fibonacci level. There's a lot of confluences here. Why not sell? Now, let's see what would have happened to those traders who would have thought that right there. So the price moves down a little bit, jumps up. Price moves down further, jumps up even further. And then the price is absolutely blown through this resistance right here. Now, a lot of you might be wondering, what was the mistake? After all, there was enough confluences, everything seemed fine and dandy. But the mistake isn't anything as simple as indicators not checking out. The mistake is mental, and it's a strategic mistake. See, when it comes to Forex, big moves are only for big players. Forex is a game of the elites. The markets are manipulated, prices are shifted in order to stop out beginners, retail traders, the average investor, and all of this to ensure that the big guy manages to make some more money. So what happens when you guys see a trade like this, which has perfect confluences and a lot of them? You're not the only one seeing them, the big players are seeing them too. So they're going to make sure the price moves through here in order to stop out all the retail traders who are giving them all of this sell side liquidity. So the price barrels on through here and moves up to the next resistance and support. Now let's see what's here. This is the second point where the price could return, because as you can see, it's hit this diagonal trend line. It's sort of hit the reverse face of it. Support becomes resistance, as we all know. It's getting somewhat close to another fib level and another resistance. Now let's see what happens here. So the price goes up, touches off this diagonal resistance, and then as you can see, it drops down after posting this bearish candle, and then it continues on its way for a pretty big move right here. So if you guys are wondering, what is the difference between this reversal right here and this reversal right here, which on the surface look incredibly similar, right? Because if we actually take a look at these two trades look incredibly similar. There was a bearish engulfing candle. This candle's nearly exactly the same. It's nearly exactly the same pattern. It came up, had a bit of sideways motion, posted a bearish engulfing candle. It came up, had a bit of sideways movement, posted, it's not quite engulfing because it's slightly before, but no one would notice that. You would take that trade, posted that candle, and moved down. So what's the difference between these trades? And also, the resistances were the same. There's a horizontal resistance here and a fib level. There's a horizontal resistance here and a fib level. Now, of course, you have this diagonal resistance, but it doesn't really change the trade all that much. Now, I'm going to tell you guys what it is, which is the thing which applies to everyone. And that thing is patience. See, in Forex, only a very small amount of people are profitable. And the reason for this is only a small amount of people are willing to wait in order to see the perfect trade before they want to hop in. Now you might be thinking this was also the perfect trade, but Forex is only a game for the patient. So if we look at the bigger picture right here, the price moved down from here all the way to there, and we were waiting for retracement. Where is the latest possible resistance it could have returned? So it could return here, but we can obviously see this point right here. So obviously it can return here. and it can finally have returned somewhere around here because there's another fib level and a resistance over here. So what you might now be thinking is, okay, well, surely this is the last place it can reverse. But the price is coming from down here. It's just made a massive descent all the way down here. It's blown through this level, which is a level right here. It's blown through this level, where the price rejected a few times, right? It reacted a bit, blew through it. It's reacted a little bit here for a second time, and it's blown through that. If the price was to blow through this significant of a resistance again, and having an extra confluence right here, it actually wouldn't be that smart of a trade to sit here and assume it would reverse there, when there would be less confluences, and the price has shown more bullish momentum than before. So effectively, if you're looking to short this is the last place you can place this trade. Now, the Forex traders who did that would have won this trade and not took any losses at all. The Forex traders who acted prematurely would have took extra losses they didn't need to lose. If you take trades too early and you don't wait for perfect confluences, and more importantly, you don't wait till the last possible second to enter your trade, you're gonna start taking unnecessary losses. When it comes to Forex, you want to almost miss the trade, and that's how you're gonna ensure that every time you get nearly the perfect entry. So let me give you an example of this for breakout traders. So I've scrolled a little bit back here. Let's take a look at this trade. Price has moved up quite a significant amount. It's retraced a little and now it's moving upwards. So the same way some traders will probably be looking for some reversal points somewhere around here, there'll be breakout traders looking for the price to break out of this region here and surpass this local high. So let's see what the price did. So the price moved upwards, and then it seems to be respecting this point right here a little bit. Let's see what happens. Moved up a little bit more. It's just sort of playing around this resistance right here. Let's see what happens. And boom, we've had our breakout candle, right? It's closed above this line. The candlestick's highest point is way higher than the last high right here. This is the breakout candle. And this is the point where a lot of simple traders will hop in and think, okay, I'm going to take the breakout move, maybe hope for it to run all the way up to here and then take my profits there. So now let's take a look at what actually happened after this breakout candle. I'm actually just going to place a little theoretical trade just to show you guys the sort of thing. So let's say someone entered here. They move their stop somewhere a little bit below the breakout region, like here. Even that's quite wide for most breakout traders, and they have their take profit somewhere like there. Now, obviously these aren't specific, but it gets the general gist of how people are playing this move. Now, let's see what actually happens here. So we have a little doji candle right here. Boom, this next candle just went straight through my stop loss. Now, let's pretend I had this stop loss a little bit close. Let's pretend it didn't get taken out here. We're just gonna see how this trade continues moving. I'm gonna move it down a little bit. Maybe this is a conservative breakout trader. Let's see what happens. So the price is messing around a bit more. It seems to have narrowly avoided taking me out right here. Fantastic. And the price has moved up into profit. This is great. We've got risk reward ratio of about 1 to 3.72, which is all right. It's not fantastic. And oh, we've been took out a second time. Literally, even when I moved the stop loss, this trade couldn't successfully get into my take profit before stopping me out a second time. Now, what is the issue here? The issue here, guys, is the same as in that first trade I showed you. The big institutions are not friendly. They don't want you in the trade. So what's gonna happen is if there's an obvious breakout like this and an obvious high right here that people are gonna be aiming for, big institutions are gonna move the price to take you out, and they can see where your stop losses are, and they're gonna move the price to take you out. Now, if you were looking to trade this as a breakout, what should you actually have done? Like I said in the first example, as a Forex trader, you want to wait till the last possible moment. So what could you actually have done? You could have sat here, saw this, known there was going to be some sort of retest sooner or later. You can count this as a retest, but this is basically a bunch of candles clumped together. It doesn't have really the right price action look to be a proper retest. The price moves up here, finally moves down here. Now, most people who were long in this play at this point are going to throw their hands up. Some people will have took 2 losses by now. They would have gone short, they would have gone long here, took a loss, seen it break out again, and might even have took a second trade only to get stopped out again without even hitting their take profit. Now let's take a look at what happens next. So the price is down here. It's successfully retraced past where the breakout was. This really seems too late to take a trade for most people, but in reality, this is nearly the perfect time to take a trade. So next what happens is the price jumps up from this new point down here where the original stop was, and this isn't coincidence. And finally the trade moves fully into profit and continues on its path upwards. Finally took us out in profit right here. So why did I show you this second example? The reason I showed you this is because it's exactly the same mistake as the first example with the swing trader, which is that of hopping in the first good trade you see instead of waiting for the last possible opportunity. If you wait for the last possible opportunity, you will undoubtedly miss out on trades, but you will also have a far higher win rate. You will not get taken out by moves like this. You will not get taken out by random moves like this. Instead, you will be entering where the banks are entering. And I think that's something to aspire for any Forex trader. So guys, the motto of this video is patience. You want to wait till the last possible moment, ideally to enter your trades. The point where you've seen all of your confluences and the manipulations of the institutions and banks have already played out, and you've sat out whilst all the mayhem was going on, and now when they jump in, that's when you're gonna jump in. That's how you want to play it. Anyway, guys, if you liked the video, make sure you subscribe, like the video, and comment. I will see you guys in the next one.